So today we're talking about how to get better at selling covered calls and selecting those strike prices that are either going to get you paid more cash, give you more chance for appreciation, or do a combination of the two. So the first thing to know is that in your account, you have to actually own shares of what you want to sell a covered call on. If you don't have at least 100 shares, it's an uncovered call, which is opening up to you to a bunch of unnecessary risk. We're going to look at Apple right here with our current position of 100 shares. What you want to do, number one, you have to understand where you bought the price of the stock at. If you bought the average price here, I'll show you at 147.65. You, at the minimum, want to sell a covered call at or above that in 99% of all situations. So you can do this again to focus on maximum cash flow for the premium that you're going to get paid. You can do to focus on the appreciation, getting the most stock kind of value going up, and you can get a bit of both. And you want to get some cash right now and bank on some appreciation as well. You can do a mix of each. So if we first focus on getting the maximum amount of cash flow and get that just cash paid out in premium, we want to go right now, change our expiration date to July 7th. Go about 30 days is kind of the sweet spot for options. It gets you better theta decline and it gets you kind of a good bang for your buck. You go out longer in time, but the money doesn't come into your account as quickly because theta's not burning as quickly if you go further out in time. So check on 30 days first and then go from there. Then you want to look at the current at the money strikes. At the money being 180 right now. It's currently at 177.82, the stock price. So 180 is our strike price right here. And to sell this covered call on Apple, one covered call, we would sell this and get the middle between 335 and 315, so 325. We get a minimum, sell this limit. We take the mid price of 325, right? And then we would go ahead and submit this order to sell it. But we would be getting paid 325 times 100 shares. We make $325. And if Apple's stock price goes above 180 before or on July 7th, 30 days from now, we get to keep this cash. Our shares get sold off, and we get to go ahead and then free up some capital to make new trades. That is maximum profit for this trade. Now, that's not maybe seem like a lot, but other different stocks will get paid more for covered calls because there's more volatility. If we look at an example here, same thing. We're going to look at Netflix. We bought Netflix at 344. Okay, it's up. Our position's up, which is a good thing, which you want to have. If we go ahead and do the same thing, there's more volatility for Netflix compared to Apple. So if we get the same thing at the money covered call 30 days out, we're getting a juiced up return. Again, it's relative because the price of Apple stock is 177. The price of Netflix right now is 399, so almost 3 times as high. But our premium is more than 3 times. It's almost, we're in between 650 and 1725. So call it 17, just below $17 per share. So $1,700 per contract to sell the covered call on Netflix if you own 100 shares in your account. That's where it gets kind of interesting, where you can do this multiple times over and just bank this cash selling one covered call contract. Now, the thing is, though, when you do this at the money like that, you're giving yourself a very low chance of having to keep those shares. Right now, at this point, you look at something called the delta right here in this column when you're doing it. And the delta tells you at a specific moment when you make this trade, your chances of the stock being assigned or being called away from you. In this case, it's being called away because it's a covered call and the shares are called away if the price goes up. So at this point, if we sold this $400 shares covered call, the price, the delta there at 53.6 is basically a 53% chance that this is going to get called away. We're going to have to sell our shares. That's what the delta tells you at this moment in time. If you were to sell this covered call, the delta would continue to change as the contract value and the price of the stock changes. But instantaneously in this moment, that is your percentage odds of winning or losing or having something happen or having not happening for the trade. So that's number one. That's getting straight up cash flow, cash, just pure cash in your account. If you want to be more conservative and look at taking more appreciation, but still making a little bit of cash flow, all we would do, we're going to go back to Apple here, flip it back over. So instead of selling that at the money covered call, right, at that 180 level, we want to go a little bit further out and we want to target a delta that is very unlikely to happen, or the lower deltas that we're still making a good bang for our buck. In this case, you could go all the way out to the 190 delta, right? So if Apple stock price gets to 190, then you have to sell your shares. You're not going to make as much premium here. You're going to make, let's call it $60 for a month, but that's not a bad day's work. Just swiping a couple of buttons on your phone or clicking a couple of buttons on your computer. That's still pretty good. Plus, you get the additional appreciation of the stock moving up from 177.84 all the way up to 190. So you're making a bunch of appreciation, which is the main driver of selling out of the money covered calls. If you want to then go ahead and look at a bit of both, the sweet spot, you want to focus on a delta around like kind of that 25, 30%, right? In this example, delta is about 12%. So it's a 12% chance of your shares being called away, which is very, very low in terms of this options contract. If you want to go a bit of both, bit of appreciation, bit of cash flow, go for deltas around 25, 30%. That's giving you a 25% chance of having shares called away, up to 30% chance, right? Look at the delta number right here at 185. We're getting paid $1.50, let's call it. So $150 to sell the contract. That's number one. We're also making appreciation. Let's call it just, if we just straight up had stock that we owned at 177, from 177 up to 185 is an $8 move. $8 times 100 shares is an $800 move in terms of appreciation. Plus we capitalize this $1.50 move times 100 again. So $800, let's say, plus another 150. So a $950 profit from appreciation and cash flow. That's what you do when you're looking at selling a bit of both and capturing both premium and appreciation. Now, you cannot just do this, and you can just kind of pick these areas based on the delta and based on the numbers, but you also want to combine this with strong technical chart reading. When you can do this and put them together, you're going to be able to kind of make better decisions on where to set the strikes and give yourself kind of an extra indicator on top of the delta on if this is going to get called away or not. So in this case, I would just open up a new window. I can open up a chart and we'll look at Apple. And I could see here, okay, well, lately, if we're looking at daily candles, maybe we want to put some indicators on this chart real quick. And now we can zoom out and see that Apple has been kind of trending upwards very strongly lately, but there is an area here where it kind of has topped out around that 178, 180 kind of range. So that could be an area, if you're going right at the money, that's going to be bang on for your kind of just pocketing the cash flow. If you zoom out a little bit further, can we go a little bit further? Can we go a little bit further? Let's go back and just zoom out a little bit more. Let's go to weekly candles. And we can see that, okay, that's definitely an area right there at the support level at 180 and change. So if you wanted to go out and kind of put a buffer on this to kind of get that and make sure you wanted to get the appreciation and some premium, you go and set it at the kind of the top of the Bollinger Band here on the weekly candle chart, around that 185 and change kind of area. Anything above that would be considered to be kind of new territory. It could get there, but it's highly unlikely given that the stock price has kind of been capped at that 185, 180 kind of level currently. So if we do that, we can combine this and say, okay, 185 is a good technical level to sell the covered call. It's unlikely to potentially get a called away at this time. If we go above that and build in more buffer, we go ahead again, based on the chart, technically want to be above the Bollinger Band up here at 190. We can go back into our options chain then and say, hey, 190, we're definitely in like good solid territory to not get assigned. So if your strategy is to not get your shares called away, you target that 190. If you want to make a little bit more bank and the potential appreciation, you want to go to that 185 level. And again, if you want to just get rid of the shares and potentially have them called away and make as much cash flow as possible with this kind of trade, look at the 180 level right there and sell the covered call at that level. And remember, if Apple's price was to decline, or if you could see a price coming, kind of a drop coming, if it's hitting that technical level at the top and trying to kind of, the run is starting to give out, you can go super aggressive on this and potentially go right at the money thinking that the price of the stock is going to decrease. If it does, if Apple's price does decrease, then you'll make money much quicker with these covered calls, not have to sell your shares at all, and be able to kind of capture some premium quickly and turn around and do the contract again if you buy back to close a little bit early. If you want to know how to sell covered calls and combine them with naked puts for weekly premium and income, make sure you check out this next video in this series. My name is Andrew. I'm teacher of all things interactive brokers, TradingView, and options trading overall. Thank you for watching this video. Subscribe if you got some value today, and I will catch you on the next one.